All right. Good evening, everybody. Appreciate everybody tuning in for another LFI monthly meeting. Today, we're going to have our guest speaker is going to be Mark Kenny from Think Multifamily. Mark, I'll give you a welcome. Thank you for coming on.
Thanks for having me, Chad. I appreciate it.
Absolutely. We'll jump through some quick announcements, and then I'll kick it back over to you here real quick. So announcement wise for the community, just to let you know, you've hopefully seen something, but we've got our 2023 meetup in left field scheduled, and we've got a venue booked. So we're moving forward on it. We don't have a registration in place yet, but we'll get that up here shortly so we can start registering people for it. It's going to be October 4th through the 6th here in Columbus, Ohio again. We'll do a welcome get together on the evening of October 4th. And then all-day meetings on the 5th with a happy hour afterwards, and then half days of meetings on the 6th, on the Friday. So hopefully people can join us for that. We got a fun venue that we'll announce in a little while to build the anticipation for it. But looking forward to that again this year. Second announcement, wanted to let the group know that the TribeVest Fund is fully funded and is now closed. So fantastic that we reached the full funding on it. The left field community contributed over half of the $500,000 raise that they were looking for at TribeVest. So a big thank you to all the participants that got involved in the TribeVest Fund. Really excited to see how that one goes. Quickly, upcoming webinars. We have a busy week this week. We've got a left field LFI Lunch and Learn tomorrow with Hearthfire Holdings, talking about how to deliver value in self-storage. We have an infielder mound visit tomorrow night at 7 p.m. Eastern. We've got a LFI next gen meeting tomorrow night as well at 8 p.m. Eastern. Then on Wednesday, we have an Open Tribe webinar with Crystal View Capital. They deal in mobile homes and self-storage. And then finally, on Thursday, we'll have a LFI Preferred Partner Deal webinar at noon Eastern with PassiveInvesting.com and their Car Wash Fund 6. So be on the lookout for those things this week. Busy week. Then next thing was that we've opened up some clubs in the new website, and we've got quite a few that have started. One of the things I wanted to point out was a Tribe Finder Club. So for those of you that are looking for to be able to get into a tribe to invest with other people in the community, go check out those clubs and see what you think. We're going to kick off a meeting for those here in a couple weeks because we have enough interest in there right now. There's also regional clubs starting to pop up. We've had a Boston, Seattle, Charlotte. I put up a Columbus one because shame on us that we didn't have a Columbus one yet, plus some others. So be on the lookout for something local if you have the interest in getting together with other left field members. Should be fun. And then lastly, the new website is up and running. Hopefully everybody's had a chance to get in and take a look around. We've been working on some kinks, but I think we've got most of it flowing pretty good right now. So we feel excited about it. Hopefully everybody else does too. Take a look, and if you have any feedback on it, feel free to send us your comments to info@leftfieldinvestors.com, info@leftfieldinvestors.com. Appreciate it. Love the feedback too. So with that, Mark, I'm back to you. And again, thank you for coming on and sharing a bit about Think Multifamily. Maybe first off, you can just start off with a little introduction. Tell us a little bit about you and the company and that kind of thing.
Sure. Yeah. Thanks again, Chad, for having me. So quick background, I started investing in small multifamily, like 2 to 4 units, actually over 30 years ago now. I was a senior in college, and I have an identical twin brother, and it's kind of one of those functions where nobody we knew really was doing it, but we were like, hey, everyone needs a place to live, so why don't we look at real estate? Didn't really know what we were doing at all, but started buying small properties, and then became a CPA for a while, did IT consulting, had an IT firm, got married pretty young, and my wife and I continued to buy smaller properties. Then 2013, I invested passively first in a syndication. I didn't even know what syndication was until 2013. A friend of mine was putting a deal together. invested in that, invested in one or two other deals passively, and then started becoming a syndicator. Since then, my IT business been, I've stopped doing that quite a while ago, and years ago, and done over 18,000 units, 14 states, which I showed kind of a map of that as well. Currently have about 12,500 units. We've sold some, obviously, that's why the number's smaller, and about 1.5 billion or so in purchases. So that's kind of a background on what we do. And then we also have in addition to syndicating, putting deals together, have a coaching mentoring program as well, and then host some events as well. Kind of a quick background. This is where we're at right now as far as state-wise. We just got one in Arizona too, so I need to put that on there. I put it on there because there's a lot of people looking southeast and things like that. So overall, it's 14 states is what we're in, and we learned a lot during COVID. So I'm on my 120th deal as a general partner. Definitely have made mistakes. Definitely have a lot of tough lessons learned. And I show those 14 states because, of the 14 that we're in currently, there are several states not going back to at all, just because of the way things were handled in some situations during the pandemic. And then also with some of the insurance costs, which I'll talk about here in a second too, in some areas, it's really making it very difficult to have a deal work in some areas. So I have some things here I'm going to go through as far as just some lessons learned, some of the things as far as what I'm seeing in the current market. We're still very active, and deal flow has been down, this year compared to, previous years by a bit. I think last I saw it was down, over 70%. Picked up a lot the last couple of weeks. But when you start looking at different deals and your criteria, things like that, insurance is definitely one of those areas that you need to be aware of. And it's one of those things you have very little control over. It's not regulated. And a lot of providers will leave a certain part of the country. And now you're kind of stuck with, just a couple options. So to put this in perspective, we have deals in parts of Florida that went from about $500, per door per year to up to $2,500 on renewal. We have this is a bigger number. We have a deal in South Texas. First year was $600,000 for insurance. On the renewal, it went to $3.6 million. So a $3 million increase in expense line item. I don't care who you are. That's impossible to make a deal like that work. Now, fortunately, as of right now, the lender's working with us on that, so we're not paying the 3.6, but that's what the renewal came back with if we were to have to meet the lender's requirements. So these aren't like little increases here or there. They're substantial, and in some cases, this example, $3 million increase in expense, that's literally a deal killer. I mean, I don't think there's any way around it. Fortunately, we're not there yet, but that's one of those things where we have no control over. Nobody said, a year ago, and everyone thinks they predicted insurance costs going, 6 times as much. They didn't. So that's a big thing. The other one is the property tax increase. Some parts of the country, even for my home residents, and I own some land a little bit here in Texas too, and pretty hard to convince me that pricing went up last year, but my taxes did go up on every property I own. I own about 4 parcels right now, and then a home, and then we have a house that we're moving into after this one. It's being renovated, so that went up as well. So property tax increase, you can fight it, you can sue the city and things like that, but it's a big issue potentially, and the lender is going to make you escrow and pay the full amount of the property taxes that the county and city allocated to you, even if you're under litigation, for example. The lender is going to make you put the full amount in there. They might change it if you win, but be aware of that. I had an example recently where someone's like sent an email to the lender saying, well, we're under like litigation, things like that, so we're not going to pay you, the lender, the full amount. It's not the way it works. So those are huge numbers. The less deals have been listed. I mentioned that. Again, it's picked up over the last couple of weeks pretty substantially. I'm not saying they're all good deals or anything like that, but the deal flow has picked up a lot. We're doing a lot of refis as much as we can, trying to get out of some of the either high interest rates and in some cases even floating interest rate loans. People are under the impression that if you have even like a Fannie or Freddie loan, that the rate's always fixed. That's not the case. You can, just like you can have a bridge loan that's fixed as well. But these loans where interest rates have gone up, from the 4s up to the now in some cases 10 to 11%, that's a big increase, obviously. And while people can sit and say that, hey, we knew interest rates were going to go up, I would just say point to many podcasts in the from the last year where someone said, going to be 10 rate hikes in a row. Nobody was predicting that. They weren't. So that has a huge impact. So my opinion right now, if you can do a refinance and get out your current high interest rate loan and go into a fixed type of loan program, I would suggest doing that. That's what we're looking at doing. Some people would argue, well, aren't those rates right now, even on the fixed, higher than they were, 2 years ago? Yes, they are. Are they going to go down? I don't know. I don't know the timing of that. I mean, I would say yes, they'll go down at some point, but I don't know the timing. No one else does either. So a lot of refis happening. Most of the deals right now that are coming out that look like they potentially work really related to loan assumptions, which means you're taking over a loan from the seller. So you're going to come in, you're going to now become the KP, key principal, guarantor on that loan assumption. With a loan assumption, you typically aren't going to get any CapEx dollars in that loan. And you do have an option in some cases, if the loan supports it, to do what's called a supplemental loan. Just think of that more as kind of like almost like the HELOC on your house. It's a second loan. But a lot of the deals right now don't support it, meaning if you try to assume a loan today and get a supplemental loan, most cases a supplemental loan is going to be zero or not very much. So you're probably better off assuming a loan today, in my opinion, and then doing a supplemental loan down the road. That would probably be a better option. So definitely seen a lot of loan assumptions. And why is that? Well, the rates, some cases are in the 3s on some loan assumptions versus, even on let's say agency debt, let's say 6.5, 6, and on some of the bridge debt, it's 10, 11%. Huge difference there. So the last one on this slide is 1031 funds. Definitely seen a lot of 1031 funds. We've done a number of syndications with 1031 investors in the deal. The amount of capital in the 1031s as a whole is going up drastically. And it's one of those things that we like if we can get it into a deal. Because usually it's a pretty big investor. So those are some things there currently. Definitely some of you probably have heard some rumblings already, and it's really uncommon right now. Unfortunately, some deals are going back to the lender. The people have stories about what happened. If you're not really familiar with the stories and people are just telling you and they're not familiar with it, you just take it for what it is. But in some cases, the people can't pay the mortgage, what it might be, and these lenders are getting a lot more strict than they've been in a long time, and they might take your property over. Now, typically, most of these loans are non-recourse, means you don't have personal liability, but that's going to be definitely a career-limiting move if a lender has to take a property over. But it could happen. Capital calls. If you're in deals right now, depending when they were bought, it's not uncommon where there are capital calls being, invoked right now. Capital call, essentially, you're going back to the members. I would always start with the general partners personally. Any deal we have, see who's willing to contribute. If there, for some reason, you can't fulfill a shortfall through the general partnership team, then you could go back to limited partners and structure it multiple ways. I won't go all the ways you can structure it. What could just be a member loan? That's not a capital call, it's a member loan. The end of the day, there's an interest rate associated with that. There is no equity dilution if you don't participate, but that's member loan. You could do the actual capital call itself. You don't participate, then you're usually going to be diluted. In that case, in some cases, even penalized, depending on how your private placement memorandum documents are written. You could do a rescue capital, which is the next item on there. What is that really? That's where, let's just say we're all in the deal together, and let's just say Chad is a general partner on it, and somebody else comes in and says, well, hey, I'm gonna put a couple $1 million into this deal that you guys are all invested in, and that particular person is going to take priority over everybody else in the deal, over GPs. In fact, there's a good chance they'll kick the general partnership team out. And then they're going to take priority over all limited partners too, meaning that new investor, let's just say for sake of argument, you had a $10 million raise and you have a shortfall and you need $2 million to sustain. Well, somebody could come in with $2 million and sit in front of the $10 million. Generally speaking, they're going to have pretty high return expectations, potentially short time frames. It's not going to be really advantageous to most people in that situation, but that is something that there are a lot of people that are doing right now. Rescue capital funds being started, but just realize on the backside, if you're already an investor in that deal, the rescue capital on paper might look good, and the reality might not be that great. It just depends how things go with the deal. I think some deals right now, we own 75 properties currently, but some deals that are maybe areas, hey, we're not interested in continuing in that market anymore for whatever reason, because of the way things were handled by during the pandemic, things like that. Some cases right now, if you could sell a deal and break even, I would much rather do that personally than go and ask limited partners for capital. It's my opinion, my perspective on it, but that's one option. Distressed deals, we've done a lot of distressed deals. I'd be really cautious about doing those right now, and I'm talking distressed deals usually from a physical and a demographic standpoint. We've had deals that have been 0% occupied, 20, 30% occupied. That's much different than a deal that, if you want to say, is distressed because of an interest rate hike. So I would be leery of the real true distressed deals. If you're not a contractor and things like that too, I probably wouldn't even look at them personally. They're a lot harder to get loans as well. And then the last one on there is the Fed. Everyone wants to know what the Fed's going to do. And I talk to people on a regular basis, and people are very emphatic about what's going to happen. And it's like, would you put all the money you have owned to your name over the Fed's going to increase rates or they're not going to increase rates? People aren't going to do that. So while people think the Fed's going to pause, well, I certainly hope they pause, hope they would cut rates. Nobody knows what they're going to do. Their objective is a little bit bizarre to me. The way they're handling things, my personal opinion, is a bit bizarre. But the Fed has had a huge, huge negative impact to the multifamily space and other spaces as well. People will say, well, multifamily is in distress. My comment would be on that, well, there are some, and there are some that are performing extremely well. We have a big portfolio, and some are kicking butt, and some are definitely, challenging, to say the least, right now. I think you have more of a floating rate or issue than anything else. A lot of these properties are still occupied, highly occupied, and operational wise they're doing good, but the rates are definitely having a big issue on that. So just be careful of that as far as the rates. And then I don't know what people in some cases, they keep looking back at the way things were or even what's happening today. My whole thing would be, let's use the information that we've all learned during this time. Can't go back, unfortunately, and change what's the past. But I think if you can find a deal right now that works, I don't know why you wouldn't move forward. People are like, oh, I don't want to invest right now because of, the interest rate hikes and things like that. Well, the reality is you can come in today with a lot more certainty on a deal than you could have 6 to 9 months ago. Totally different world right now. The uncertainty, while it's there a little bit, it's nothing like it was before, where interest rates went up, 520 basis points in, just a few months. That I don't think is going to happen. So just be leery about that, though, but I would say take the information, make better business decisions. I won't go through all this. It's more like markets you're looking at, but buying in a lot of different states, buying a lot of different types of assets, I'm kind of the opinion, and maybe it's a little bit too, just as a, older I get too, that I'd rather buy some properties at one, or less headaches, two, better markets, lots of industry, lots of, population growth, job growth. Bottom left, without a question, landlord friendly. When I hear, and I used to say, some states are landlord friendly, the very few states are landlord friendly. There are some, and the states that are so-called landlord friendly, they're not. It's county by county. You can be in a state where one county is, definitely for the landlord, and the other county is definitely for the tenant, and they're drastic. We still have some parts right now in the Southeast that are taking 9 to 12 months to evict. And then we have other properties in the exact same state, they're taking the typical, 2-3 months to evict. So drastically different the way local county judges are handling evictions. So be careful of that. And then this is, in my mind, probably as important as it has been, people that are looking for deals. And I'm going to go into one more slide on financing. But if you're looking for deals right now, people would say, hey, it's now a good time to get started in multifamily. I would just say, if you're newer, yeah, I think it's a great time. I'm not just saying it because I'm in the space. I'm saying it because most brokers right now have more time than they've had in years, frankly. You have more opportunity to meet them face to face. You can go look at, if they do have a property that maybe is listed or off market, you can go look at it that way. You're just going to get more attention now than you would have, previously. You want to make sure you have qualified partners. A lot of people trying to sell deals right now, they really want to make sure that the buyer can close. That's always been important, but it's even more important now. Don't pester the broker if you're looking for deals. You don't want to call them every single day and things like that, but you definitely want to keep in contact with them. Market size, as I look at different deals we've bought and market sizes, if there's not a story, you can have a deal in a smaller market, you can, but there needs to be a story there, and or you need to have some sort of historical experience in that submarket. There are markets we buy in that are relatively small, but they've done phenomenally well for us. So, and we, I just want to say, kind of got lucky initially finding those markets. Crime is definitely a big issue right now. I'll talk about on lending as well, but if there's crime, used to be at the property, then there are big problems potentially with the lender, limit the number of lenders interested in the deal. Now it's the submarket has crime. We've had deals towards the end of last year, virtually no crime, a real, they might have a little petty crime, of course, but no real crime to speak of on properties. And we had major issues with getting lenders to get proceeds because the submarket had crime. And if you think you're going to go into buy a property in a submarket that's not good and has high crime and things like that, and you're going to change that one property, it's good luck, probably, is what I have to say, because it's really difficult to do that, to re-tenant a property. You can put up all you want, cameras and fences and things like that, but unless you're going to buy several properties or a couple blocks in that submarket, you're going to have a really hard time changing that over. Then you could get stuck with security costs and things like that too, that are, well over $100,000 a year. A unit size, as we look at it, this is like the individual unit size. We had one deal that had some pretty small unit sizes, and we had a really hard time with a lender. In fact, we couldn't even get agency debt on that because those units were smaller. Still a good market. Property was nice, but the unit sizes were small. And then kind of more of a tip here on, I just added it here as far as when you're looking at deals and you get deals, be careful about splitting the work up once you have a deal. If you say, well, hey, we're going to renovate this property, we're going to have a general contractor do 90% of the work, and then we're going to have the property management company in-house team finish off the last 10%. My experience has been that doesn't work well at all. All you do is get people blaming each other. It takes much longer, and in virtually every case, I would say it probably costs more money. So I would just hire somebody. You either do it yourself if you have the expertise. If you don't, hire a general contractor. We use a term, chuck in a truck, where you have a local little dinky, contractor you have some pretty significant CapEx, I would go with more of a larger reputable GC. You pay them, of course, you're going to pay them probably more on paper, but if your whole business plan is to get things renovated, quickly leased up at higher rents, then it's going to cost you less money in the long run. Financing, this is really critical right now, but I'll give you kind of some observations or tips. As a mortgage broker, we do. So a mortgage broker will go shop different loans for you. That's really important right now because of the way lending is working. It's more challenging now. It's also harder for a lot of people to get loans. They could have probably got them, a year and a half ago. Pick the correct loan type for the project. When I hear people say comments around, hey, bridge loans are bad, I personally would just say that to make a statement like that is not a good statement, because in a lot of cases, bridge loan could be a perfect example for perfect solution for a deal. Let's say you have a huge CapEx deal, $25,000, $30,000 a door of CapEx. Well, do you want to raise all that money, or do you want to go into a bridge loan that would typically give you 100% of the CapEx in the loan? Or I hear people that will say, HUD loans are bad and things like that. There's no such thing as a bad or a good loan. It's based on the type. There's no such thing as, this loan is always fixed. This loan is always, variable. You can get bridge loans that are fixed, and you can get Fannie and Freddie loans that are variable. So just be cautious of all the comparing you're going to do. And then again, if you're not going to get CapEx in a loan, you're going to have a much, much higher raise. Recourse versus non-recourse, I would say this is probably as important as anything right now for a lot of people. I know some people that own a lot of smaller properties that are recourse, and they're a little more nervous. I think anybody that's in trouble on a deal should be nervous, but the reality is, can the lender come in and invoke recourse and go after you personally, yes or no? To me, I want to have non-recourse loans. The CapEx strategies are important when you're getting a loan. Some people don't do enough work up front, and they put dollar amounts with different categories, and depending on, let's say, for example, roof and foundation and parking lot, and then they actually hone in on the real numbers of what it's going to cost for each of the categories, and they want to start moving dollars around. Lender's not required to do that. So a good lender will do it, but frankly, there aren't a lot of good lenders out there, in my opinion. So just be careful of that. We've had situations where a GC had to be approved up front, and it was a process. I would guess this general contractor spent probably a minimum of 30 hours of paperwork, and I'm not exaggerating how much they had to put together up front before this lender would approve them. Absolutely ridiculous in my mind. It's a contractor we use for, we did probably $50 million with this contractor, and they had to go through that process with the lender. So understanding that, don't wait too long to pick a loan. You can always second guess yourself. I'm not saying to pick the first option out there, but at some point in time, if you have money on the line, earnest money is going to become hard and things like that. You're just going to have to make a decision and go. This is my opinion. I don't know why anybody would necessarily argue with it, but all things being equal, I would pick the loan that has the lowest amount to raise. So you can see some pretty big differences on the loan amounts that have to be raised for the deal, depending on how much money they're actually giving you in the loan, how much money they're holding back for capital improvements, how much money they're holding back for interest reserves, just other things like that. Number 8, will the lender allow distributions? Are the stipulations? So some lenders will have information in the loan doc saying you can't even do distribution unless your debt coverage ratio is a certain amount. Will the lender allow 1031s? It's not a given. We've had a number of lenders that do not allow 1031s. We've had a number of lenders that will allow up to 4, and we've had some that have allowed up to 10 1031 investors. So if you have a 1031 investor and you have different loan options, you want to make sure that the loan option you want to go with allows 1031 investors. What are the KP equity contribution requirements? Some lenders will require the KPs will put in a certain percent of the equity. How fast can they close? That's very, very important, especially when you have money on the line that you could lose if you don't perform as a buyer. Issues I mentioned previously with small units or concentration like student, military, those are all things that can cause issues as far as lenders that will loan to you and also on proceeds. The 13 is, can you rate lock day one? Some loan you can rate lock the day you basically are going under app approval. Other ones you are having floating rates up until the day of closing. So that's a huge thing. Is a lender also an operator? So let's just say you have a property either as an investor or even as a general partner. If the property got in some sort of trouble for whatever reason, you want to make sure, or hopefully you have a lender that's willing to work with you. In some cases, they're not really required to, but hopefully they would. But let's just say, for sake of argument, they're not being very good partner. They don't want to work with you that much. If they're an operator, meaning they own properties themselves as a lender, then they could much more easily take over your property, and they'd be more apt to do that versus a lender who is just a lender. If you want to say they're not an operator, so I would all things be equal, I'd pick a lender that is not an operator. And then does the lender sell off the loans? You've seen that already with some of the bank issues you've seen in the news. The prepayment penalty, what does it look like? Again, people say, oh, Fannie Freddie loans, best loan ever. We do all kinds of loans, so I'm not knocking one or the other. I was trying to do some math kind of in my head the other day on this, and I would say in prepayment penalties, we paid millions and millions of dollars in prepaid penalties to the tune, I wouldn't be surprised if it's $40-50 million in prepayment penalties by having some fixed debt loans that when we sold them, it still made sense to sell them because the appreciation was so high. But put it in perspective, we had a deal we sold. The loan was I think 6.75 million loan, and our prepayment penalty was like 2.8 million on that. So obviously a huge number there. Rate caps, if you're not familiar with that, that's not that cap rate, it's rate caps. That's kind of an insurance policy, interest rate protection. Make sure you understand those. They went up, I think like 900%. So very expensive. They weren't before, but they're expensive compared to what they were previously. And the interest reserves I have on there, that's where the lender will typically set aside some sort of funds, and it will be set aside to be able to pay for a shortage on the mortgage payment. So upfront, the deal doesn't cash flow, so the lender will put money there. Really important to understand that by itself. Who's putting the money in? Is it a lender, or they want you to put it in there? Will they let you use all the money at a time? Meaning, if you're short, or if your mortgage payment is $100,000, can you use $100,000 your first month of interest reserve, or will it only allow you to use a shortage? For example, you're short 20,000. And then one thing we've seen more recently towards the tail end of last year, and I'm sure it's been there in the past, but not really as much, is that there's some language in some loan docs that say you can use the interest reserve, but then you have to replenish it at some point in time. That seems about as ridiculous as I possibly could imagine. You have money set aside, typically paying interest on it, by the way, and the lender says, we'll give you money, but within 15 days, you have to replenish the money we just gave you. I don't even know how that makes any sense, but we've seen that on some deals. So those are all, I go through a lot on the loan piece of it, because this is where a lot of people have had problems lately, right? Loans with interest rates and kind of getting maybe wrong loans for the deals, the insurance, certain parts of the country going sky high. Be careful of that. And then as you're looking for deals and things like that, just you want to be aware of those different things. Now, again, I would use that information to make better decisions in the future. And I still believe that multifamily is a great investment. It's much more challenging to find deals right now, no question about it, but they're still out there. And if you can find a deal right now that works, I think you probably look back in a couple of years from now and say that, hey, I really got a really good deal on that from a cost basis perspective. So And then there's my my contact information. So just kind of sharing different aspects that way. And I'll open it up, Chad, to you.
Yeah, no, great. Mark, thank you for sharing that with me or with the group. I should have brought up ahead of time, if anybody has questions, please drop them in the Q&A and we've got time to take a few. So I'll kind of kick things off. I appreciate the speech or the background. Really interesting. It definitely relates to your coaching with becoming GPs. Left Field's a community of limited partner investors. I think it's great to see your take on all of those pieces to help us understand your strategies that you go out and look for properties on and so forth. So thank you for sharing that.
Yeah. And I think probably even to your point a little bit too, like as an investor, the average investor probably wouldn't understand, a lot of the loan lingo and the loan options. A lot of them wouldn't. So you probably do want to understand that pretty well as an investor. And then understand how things were handled during the pandemic and things like that, because the loans right now are what's causing a lot of problems for people.
Yeah, I was going to say, I bet the limited partner investor knows a lot more about loans today than they did a year
They
ago.
do, unfortunately. Unfortunately, that's not a good thing, but they do.
That's fair. I feel like that's a priority in all our deal discussions anymore,
Right.
but it's good stuff. I guess the first thing I'll throw out there for you to speak to, I know a lot of times, when we see an operator that has the volume that you do, we always ask about the team and how you support that volume of properties that you manage and so forth. Can you speak to the team
For sure.
structure that you have a little bit to help us understand how that gets managed?
Yeah, and I would say historically it's been a little different than it is now. I'll tell you why, and it's better now, by the way. But so we have coaching program. People in the group can find deals if the deal makes sense to partner on, which I've done in the past. And then we've usually allowed that person, if they want to try to help asset manage the property. That's on the asset management side, which I'll come back to. Third party property management we use right now. So across the different states that we're in, we use different property managers. So that team is really a third party outsourced. The asset management, I'll come back to that because it's so critical. And frankly, I think that a lot of people on the call, and you, Chad, and myself might sit here and go, well, that just seems like common sense. Well, I can tell you I've scratched my head a number of times when people do certain things as an asset manager on a deal, and I'm literally blown away, not in a good way. So what we've done is we started hiring for the tail end of last year, asset managers in-house. And an asset manager now, if I'm on a deal, they have to be 100% dedicated asset management. They cannot source deals. They can't raise capital. They can't do anything else. That's all they do is asset management. And there is a pretty big difference between a lot of these asset managers just from a skill set standpoint. It was much easier before, as a lot of us probably know, when things were just, hunky-dory, no issues. As times got tougher, hands down, having these asset managers, manage these assets for us. Frankly, I really wish we would have done it before. Can't go back, but that's where we're at now. And then on the, we have some IT stuff. We have, not that it matters, some marketing. We have event planning type, roles, things like that. But from someone looking from an investor standpoint, probably more concerned around the two main things, property management and asset management. So if your lead syndicator, general partner putting the deal together, let's say for example has a full-time job and they're doing this on the side, which is not uncommon at all. That's why I started. Or they're also going to continue to look for additional deals and things like that. I'm not saying they can't hit it out of the park, but I would be very leery as an investor investing in a deal like that.
Yeah. No, and we encourage the group to do their vetting well when it's a greener sponsor. I actually like the model where you're co-GPing in many cases to help bring those newbies along as they're learning the space and so forth. There's a sense of security that Mark Kenny's name's on it as well. For me, as I've invested with you anyway, so it's been helpful to see you tag along teaching them, because we never know who the next great operator is going to be. So I love to get the exposure to
that's right
people, but I love having your veteran capabilities coming along with it too.
And the data, I mean, frankly, the data being shared, I don't think it's necessarily like just not being shared, right? They don't know the right data, or they're, so now we have a lot more controls in place as far as we proactively go grab the data ourselves.
Yeah,
And then we have, dashboard and things like that. So that's been very helpful.
yeah, great. We got a question that came in then here from Steve. What is the largest apartment complex you own or have owned? Do you think you lose ideal economics of scale if the apartment has too many units? I mention this because this was listed as one of the things that made it difficult to manage the recent Houston apartment foreclosures, i.e. 700 to 900 units.
So we've owned over 700 on a single property, 500 on others. So, the 500 to 700 we definitely have done. I mean, the disadvantage to having it all, that was multiple properties, by the way. I think, the Houston fiasco, right? I think there's definitely economies of scale. The larger you get, what I want, 700 to 900 units in a single property, probably not anymore. Probably a couple of years ago, I would probably thought differently. I don't know what the right number. It seems like that, I don't know, 400, sub 400. I'm making the number up a little bit on the fly, but that probably feels pretty good to me. But I don't, this whole thing with, the economies of scale for the Houston deal, there's a lot. I don't know if people know or don't know. There's a lot more to that story than probably most people know, and it doesn't have anything to do with economies of scale. If you buy a huge distressed deals and huge value add deal, and it's 700 to 900 units, and it's across multiple properties and things like that, in a tough market, it's really difficult during that time to do it. But I think as a limited partner, if you're investing, you're not going to probably increase the amount you invest because the property is larger versus, a 50 unit versus a 500 unit. You're going to invest whatever you typically invest. But I would say, yeah, we looked at properties in Houston before it was like 850 units. It was like 2 blocks. And looking back at that now, that was probably 5 years ago. I didn't think much about it then. Now looking at it going, yeah, probably a little more leery. Or if you're in an area of the country where the judge is, very pro tenant, and you have that property. I mean, we had properties during COVID we literally couldn't evict at all. I mean, it just was impossible to evict. And then take that on top of big value add deal, which those properties were, and you have a double whammy. You can't evict to re-tenant, and during the pandemic, we couldn't really do CapEx for a while either. So I do think it's a good observation that Steve had. Again, I don't know the right number, but I'd say, 400, sub 400 probably sound pretty good to me. That 700 to 900 starts getting a little bit nerving, yeah.
Steve dropped a follow-up here. The main issue was the fact that he had no
rate
rate
cap.
caps.
Yeah. There's no question, with not having a rate cap right now stinks. I would say it is, where the rates keep going up and up, and thanks to the Fed, I don't really know what they're trying to accomplish, frankly. I know what they say they're trying to accomplish, but and people might say, why would anyone not get a rate cap? I mean, everyone knew rates are going up. Well, there are a lot of people that we have some deals that don't have rate caps. So that's why I mentioned, if you can go from a deal with no rate cap into a fixed loan, I would do that all day long. And or if you have, the deal, if it needs capital to survive and you can sell today at, breaking even. Yeah, you didn't make money, but I still think that's a win in some cases in today's environment, unfortunately.
When I think of one of the other investments I was in with you with the properties in Dalton, Georgia, you ended up with some scale there because you had a decent chunk of the market, but it felt like that afforded you different exit strategies than you would have had you only had 75, 150 units or whatever the case was. So
it did.
Yeah.
We knew a fair bit about that market. We only had one deal there, but fortunately, one of the guys I partner with has lived there for 28 years now. He was a broker with Marcus Millichap, so he kind of turned me on to a couple of these little smaller markets, because I never heard of Dalton until 2018 actually. So
and you end up with 20% of the market before it's over with.
Yeah, for sure. Yeah.
Next question that popped up: what are your thoughts on these tax abatement deals in Texas? Pros and cons.
Yeah, depending on what they are. So I don't know if these are existing deals or development or redevelopment, probably what it is. I mean, I have some land I own here, and I'm not really a developer, by the way. And I have some land that I put an offer in here in North Texas. And I liked it for one. I met with the city, and they're a city, one, they're easy to work with, and they're kind of like roll out the red carpet type, and they'll give tax abatements, they'll put utilities in there and things like that. So I don't know all the ins and outs of that. If it's a tax abatement type thing where, this would be more on property taxes I'm referring to for my example. In some cases, low income tenants, okay, you just responded. Not a fan. I'm just not. Not that low income people can't be good renters, but that's typically you're going to have more issues if you want to take a percentage of it.
Oh, he's talking about existing multifamily properties.
Yeah,
Yeah.
and there some of the people, some of the low, low income housing abatements, things like that. Some of them, they're all different, by the way. I mean, very different. So in some cases, the rent amounts are actually still pretty high. In other cases, it's also just a portion of it. So it might only be 20% of the tenants have to be, certain medium household income, basically. So they're all different, but I would just say the more I've done it, more deals I've done, demographics are huge. And the clientele base is significant. So, we bought a lot in Memphis. People would probably cringe in Memphis. We've done, I mean, amazingly well. I mean, crazy well in Memphis, but it's a tough market. And I wouldn't actually go there right now. I think the pricing, we were buying stuff for $30,000 a door in 2017 or so. Sold a lot of deals, still own deals there. They're performing great. But I would avoid some of those markets where demographics are tough and or low income, unless it's just something you want to get into as a business. I have no desire to get into that. I think it's headaches.
Very good. One thing I was going to ask you about too, I know COVID threw curveballs every which way that, forget about how many years you've been doing this. Nobody's been through a global pandemic before and had to deal with that. Can you talk to how some of your strategies changed, maybe how you source differently and so forth? Because I know supply chain was difficult there for a while and labor costs went through the roof and everything else. Can you speak to maybe how your pivots, your strategies changed during that time frame?
Exactly. Yeah, it's a good question, and it has changed. So if you just starting with the obvious one I mentioned was, how did the county react during the pandemic? And it's not to say every county is going to react, if we have another one in, 2 years from now, it's going to react the same, but you kind of want to know politically where the county stands. Let's be real about it. That's what's going to control how they're going to react during a pandemic. I can't argue with that. The other thing I would say is we had bought deals that were distressed, where the business plan really only worked if you did two main things. You had to re-tenant the property, and you had to completely, redo the CapEx on the property, right? Interiors, exteriors, everything like that. We had a couple deals that, bought, and then a couple months later, COVID hit. We couldn't do either. So I'm much more of the opinion now, buying deals that, yes, it has a value add component to it, but can the deal still work, if you want to say, and work pretty well, if you didn't re-tenant it and you didn't, do a bunch of CapEx to the property. And there are a lot of deals out there that will still work. In fact, we bought deals before we plan on doing CapEx, and we're like, we're raising rents quite a bit without doing anything. So we just go in and do light rehabs. But those are probably the three main things: how are evictions handled, and then the re-tenanting. I don't want to buy, 20-30% occupied buildings anymore. Just don't. And I don't want to buy a building that only works if we do a huge CapEx project on it.
No, I think that makes sense. It'll take a while for the sting to wear off from all of that, I imagine.
Right.
And, get to a different strategy. But any other questions out there? I will kind of pause there. We do usually do a networking event afterwards. I think we said last month that the software that we use they were going out of business. So last month was the last time we could use that. But we stuck Steve, we sent Steve out, didn't stick him. We asked him to go out and look for new software to use. And we've got a different system to use this go around. So we are going to do some networking afterwards. Oh, thank you, Steve. He just dropped it in the Q&A. So if people are free to stay on afterwards to do some networking, you're more than welcome to. But Mark, I think we'll pause there. It looks like the questions have dried up. So I really appreciate again,
it.
yeah, you coming on. You know, Think Multifamily is one of our preferred partners. So we appreciate your support of Left Field and what you've done for us too. And personally, I've really enjoyed investing with you as well. So thank you for that.
Thanks, Chad, for having me. I really appreciate it. Thank everyone for their time.
And I think we have you on the list for a deal webinar coming up soon too. So we'll be seeing more of you. So
all right, sounds good
for that. All right, appreciate it, Mark.
Thank you. Take care.
For those of you that want to jump over to the networking, just click on the link in the Q&A and we'll see you over on that site. Thank you.